If you've been anywhere near the crypto markets lately, you definitely felt it. The last few weeks, man, they've been a total roller coaster of fear and confusion. And it all kicked off with one historic, gut-wrenching crash. Today, we're going to unpack exactly what happened, why it went down the way it did, and what it could all mean for the future.
To really get a grip on the panic, you have to start with this number: $20 billion. Just gone, wiped out in a single day. This wasn't just a bad day at the office. It was the single largest liquidation event in the entire history of crypto. A massive financial shockwave for sure.
And a shockwave that big? Well, it brings up the one question that's on everybody's mind. After hitting these unbelievable highs, the market just fell off a cliff. Headlines were screaming that the party was over. But is that really the whole story? Or is there something else going on just beneath all the noise?
So how does a market even fall that fast and that hard? Well, it really comes down to two key ideas: leverage and liquidation.
Okay, think of leverage like this. You're borrowing money to make a giant bet. It's kind of like walking a tightrope. When everything's going your way, the rewards are absolutely massive. But if the price moves against you, even a tiny bit, that small misstep can lead to a very, very big fall.
And that fall, that's what creates this crazy domino effect. It starts with just a small price dip, but that little dip forces the most over-leveraged traders to sell. Their selling, of course, pushes the price down even more, which then triggers the next round of liquidations and then the next. It's just this vicious self-feeding cycle, a cascade that gets worse and worse. And that is how $20 billion can just vanish in a day.
But here's where the story gets really interesting. While all the headlines were screaming crash, a completely different narrative was playing out behind the scenes. What if this brutal sell-off wasn't the end, but actually a necessary reset?
You see, there were two totally different markets playing out at the exact same time. On one side, you had what we call the weak hands. Retail traders, spooked by the scary headlines, just panic selling everything. But on the other side, you had the strong hands. These are the large institutions, and they were steadily buying. The data actually shows that the new crypto ETFs saw positive inflows during the dip. So, while the weak hands were getting shaken out, the strong hands were more than happy to scoop up their coins at a discount.
And this wasn't just a vibe. The charts totally back it up. Right at the peak of the panic, the price hit a solid floor. It found support at a key long-term price level that serious traders watched like a hawk. For them, holding this line is what separates a healthy correction from a real full-blown crisis. And even with the biggest liquidation event in history, that line held firm.
So, what does all of this point to? There's this concept called the mid-cycle reset. The theory goes that this wasn't some random crash, but actually a necessary cleanse to wash out all the excessive speculation and, frankly, the greed from the system. You know, if you zoom out and look at crypto's history, this pattern isn't new at all. Every single previous bull run has had a similar, violent reset. These massive liquidations, they were never the end. They were the painful but totally necessary event that cleared the deck for the next major surge. And that looks an awful lot like what we might be seeing right now.
So why might this time be a little different? It's all about who is doing the buying. Previous cycles were driven mostly by retail hype. This cycle, it's being defined by massive, relentless institutional demand. The new ETFs are acting like these giant vacuums, just sucking up supply and creating a level of market resilience we've literally never seen before.
Okay, so the market has been reset. The slate's been wiped clean. So where do we go from here? Let's take a look at Wall Street's bull case. This comes from Tom Lee over at Fundstrat. He was one of the first major Wall Street analysts to even cover Bitcoin, and he doesn't see the crash as a failure at all. In fact, he sees the market's ability to hold strong so close to its highs as a massive sign of underlying strength.
And based on that strength, his price target for Bitcoin is, well, it's ambitious. He's forecasting a potential run to $250,000. And get this, not in 5 years, by the end of this year.
Oh, he's not done. His target for Ethereum is $12,000. The logic here? As central banks eventually start to ease up on monetary policy, the two biggest digital assets are going to be the primary ones to benefit.
So how in the world could we get to numbers like that? Well, there's a recipe with 3 key ingredients. First, you've got easier money from central banks on the horizon. Second, you have that relentless, nonstop demand from the ETFs. And third, a potential supply shock as long-term holders lock up their coins and refuse to sell. You put those three together, and you've got a pretty powerful cocktail for a rally.
So this brings us full circle, right back to today. The panic from a few weeks ago? It's basically vanished, and it's been replaced by something much, much quieter.
We're now in a phase that's being called quiet accumulation. The on-chain data, which is basically the public ledger of all transactions, shows it crystal clear. The smart money is moving back in, quietly buying up what the panic sellers dropped. A stronger foundation is being built. The weekends, they have left the building.
So here we are, right back where we started, but hopefully with a completely new way of looking at things. Maybe this wasn't the end of the party. Maybe it was just a violent, chaotic, but necessary cleansing. And that leaves us with just one massive question. Was this the final shakeout that clears the path for the next big move? Was this the final reset before liftoff?